Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 27th of August. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how the Fed pivot is likely to support US equities and bonds. But how would that impact risky assets in the other regions? So let's dig deeper today into Euro area assets. Now, the latest Eurozone headline CPI inflation unexpectedly accelerated in July from 2.5% year over year to 2.6%. Now, energy prices largely drove that rise, and services inflation, which is more sensitive to domestic economic conditions, ticked lower in July. The August update will be released later this week, and inflation is widely expected to resume its deceleration. In the meantime, though, investors' long-term inflation expectations dipped to 2.1%, the lowest level since 2022. It stood 20 basis points higher just a month ago. So this sharp move suggests mounting growth concerns amongst investors and their expectations that the ECB can keep easing policy without risking flaring up price pressures. Now, despite GDP growth surprising to the upside in the second quarter, the Eurozone economy is fragile. For example, the labor market is deteriorating, bankruptcies are rising fast, construction activities has fallen, and the private sector's interest burden is rising. So net-net, the US economy still seems to be performing more solidly compared to the euro area. The AI-driven growth is likely to floor the US economy to a good extent, but the same cannot be said for euro area economy. In fact, Europe is quite exposed to the slowing demand in China for euro area exports. So all this explains why US is our preferred market for equities. Now, in terms of euro dollar, it has broken out of resistance near 1.10 at the start of August, as it was getting likely that the Fed would be pivoting. However, the relative strength indicator of euro-dollar pair has been at around 75 to 80 over the last few weeks. And even though the pair has been making new highs, this was done without any increase in strength. So therefore, the euro-dollar pair is prone to short-term pullback, probably to the 1.09 level. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.